Okay. So today we're going to look at tests for controls. So now this is the lifeblood of auditing. So there's test
Okay.
for controls as well as substantive testing. This is the lifeblood of auditing. In Chewa, they would say tafika pachimaki.
Mm-hmm.
Hapa ndiye pachimaki pa auditing.
Okay, okay, okay.
So test for controls is quite an interesting topic. And one of the major reasons why I covered yesterday's topic, it's like it gives you a foundation, it prepares your mind for what we're going to cover in this particular topic. So test for controls is quite interesting. So let's begin. So now
Okay.
our introduction is this. We've got what we call control objectives, then we've got controls as well as tests for controls. So control
Okay.
objectives are the reason why an entity puts in place controls, right? The major reason why a control is put into place is what we call a control objective, right? So for example, if you put in place a control, a typical example of locking the warehouse, that's a physical control, right? What's the
Okay.
objective? The control objective is to prevent theft, right? Then our
Yeah.
controls. So controls, these are policies and procedures put into place to prevent and detect and control undesirable events. So controls are policies and procedures put into place to prevent or detect and control an undesirable event, right? So now a control, for instance, we tell the security guard you should be locking the warehouse at 18 hours and you give the key to the supervisor, right? That's a control that we've put in place. That's a policy and a procedure that we've put in place to prevent theft, right? Another example,
Yeah.
segregation of duties. No one individual should be recording transactions and receiving payments. We're trying to prevent fraud. That's a control. Another example, this is where a person who's supposed to be employed as an accountant is one who has knowledge in accounts. That's a control. We're trying to prevent errors. At least if you employ someone who is competent, they won't have any errors whatsoever. Or maybe the errors are going to be minimal. So that's a control. So now, tests for controls, these are tests undertaken by the auditor to check and confirm the effectiveness of internal controls. The company has put in place a control to prevent theft in the warehouse by locking, right?
Yes.
Us as the auditors, we go to that warehouse, we test that control. We just sit or maybe we stand and observe if indeed the warehouse is locked at 18 hours, all right? If the warehouse is not locked at 18 hours, it's locked at maybe 19 hours, or sometimes it's not even locked, then we can say there's a deficiency in that particular control. The other example I'm going to give is where there's a control to employ competent accountants who are going to carry out the job. Our job is as auditors, we need to inspect or inquire from management. You know, we inquire from management. This person you've employed as an accountant, what is their qualification? If we discover that that person is a teacher by profession, then we're going to say these controls are ineffective and inefficient, and they have a deficiency. So that act of us going to the company and observing or inspecting, those are what we call tests for controls. Any questions so far?
No questions.
Okay, so I'll just go back a bit on what we learned yesterday. These are
Yes.
financial statement assertions. So repetition is the mother of learning. For me, that's what I believe. That's why I'm trying to
Yeah.
talk about it again, right?
Yeah.
So assertions for transactions, which are revenues and expenditures, which are in the statement of profit or loss. I'll say it again. An assertion, this is just a statement which management deems as true. Then auditors use those statements to test the financial statements, right? If management prepares financial statements, the CFO and the CEO, they sign, they approve that these financial statements, they are accurate, they are complete, and all information is as it is supposed to be. Then they are asserting, they are confirming, saying everything, we've done things according to how they're supposed to be done. So now, as auditors, we need to go into the business and test whether or not everything is according to how it's supposed to be. And how do we do that? We test the assertions, we test accuracy, we test occurrence, we test completeness, we test classification, we test cutoff, we also test presentation and disclosure. So occurrence and authorization. Did this transaction actually happen? Because sometimes in businesses, you might make a
Yeah.
payment for a service which was not received. So
Yes.
now, as auditors, we're going to confirm the occurrence of that particular payment which was made, and we're trying to confirm the assertion of occurrence. Accuracy. Information needs to be accurate. If managers prepare these financial statements, they are confident that everything is accurate. So now, as auditors, we need to go into the business. We need to confirm the assertion of accuracy. Were the transactions recorded according to the correct quarter amount, right? Completeness, where all
Yeah.
relevant information captured in full. We auditors were going to confirm that particular assertion of completeness. Then classification. Each and every transaction has got a respective account. Were those transactions posted in the right account? That's what classification is. Cutoff. Each and every transaction is carried out at a particular point in time. So as auditors, we go in the business, we're trying to confirm, were these transactions recorded in the right and correct period? That is cutoff. Presentation and disclosure. Were all transactions aggregated? Were they put together appropriately and posted to the statement of profit or loss or statement of financial position? And were disclosures put in place? For instance, where we have a contingent liability, you know, when we have a
Yes.
contingent liability in IFRS 37 provisions, right? A contingent liability or a contingent asset is supposed to be disclosed in the notes to financial statements. If that contingent liability exists, was it disclosed? And this is what we're trying to prove, or we're trying to test by carrying out these procedures. So now, what audit procedures are used? So we're going to use procedures consistent with the assertion. So the assertion of occurrence, we inspect the supporting documents, we inspect the ledgers, we inspect the invoices, we inspect the goods received note, we inspect the receipts if we buy some, if a company bought something, right? Then we also make confirmations from directors that transactions relate to the business. We just go and ask the directors. Here, you said you bought inventory. Does the inventory exist? Does it relate to the particular business? That's confirmation. Inspection. We go and inspect the inventory. You said you bought inventory from Dangote, inventory of cement. Okay, in the books it's written there's inventory of cement. Show us where the inventory is. We inspect it so that we ensure that that transaction occurred. Then accuracy. Accuracy, the audit procedures which you can use are recalculation of correct amounts, right? The third party
Yes.
confirmation and analytical procedures. So accuracy, we can recalculate, right? For us to check the accuracy of transactions, if maybe calculation of, say, profit, we can recalculate the profit, or we can recalculate the net profit to ensure that everything is accurate. Then analytical procedures as well. I remember analytical procedures is basically comparing. So we can compare transactions from different periods to check if there's any error. So we can compare the entry in the, for example, a sale, we can compare the entry in the sales ledger. We can also compare the the amount the amount posted in the receivables ledger. Then we're able to compare, are these amounts tallying? So if there's a difference between those two, then we'll say there's an inaccuracy. Then completeness, we can carry out reconciliation of control accounts. So for receivables to be able to move from the ledgers to the statement of financial position, there's supposed to be reconciliation. All right. There's supposed to be
Yes.
you're supposed to add all the accounts, all the individual accounts, all the balances on the individual accounts. You add them so that you create one receivables figure or receivables amount. Then it's posted to the statement of financial position. So now we can reconcile the control accounts. We can also carry out confirmation and analytical procedures. Then classification, we need to inspect the supporting document. So classification, were these transactions posted in the right accounts? What do? We just inspect the documents. If it's a sale, we check. We've got an invoice of 1 million. We've got an invoice of 1 million from Dangote. Show us where you recorded this particular invoice. Then we inspect and we confirm the accuracy in the information which is recorded in the books. Then cutoff, we use cutoff testing as well as analytical procedure so that we confirm if the transactions were recorded in the correct period. Any questions?
No questions.
Okay. What is tested? So, for exam purposes, we test the sales, the purchases, the cash received and cash paid, as well as the payroll. So for the most part, this is what you're asked about. But in the exam, mostly they like cash. So cash received and cash paid, right? So as I said
Okay.
yesterday, there are two ways in which the examiner can ask you the questions. It's either they give you a scenario where there are deficiencies in control account in the controls, then you as the student, you need to identify those deficiencies and explain them and how they can affect the financial statements. Or they can tell you, say, suggest the controls. Maybe suggest 3 or 4 controls that can be applied to this cash cycle, the cash system. Then you're just, you brainstorm and you write something. So these are the two
Okay.
major ways in which they are examined. So now let's begin with testing sales transactions. So for sales, we're going to use the assertions. So how do we test the occurrence, right? Did the sale happen and was it authorized? So one, we can choose. So these are just examples. These are just illustrations. You don't have to memorize the exact thing, but these are just
Okay.
examples that are going to help you understand what testing controls is, so that in the exam you can be able to remember. But the advised approach is where you read as many controls as possible, you watch as many videos relating to controls as possible, so that you can have a lot of ideas about different ways in which you can test the controls. So that in the exam, you don't just remember what you read, but you also remember what you listened to, what I've taught here, what you read, and what you read in the book, what you read on articles. That way it's going to be easy for you to remember the controls. So let's carry on.
Okay.
So test for sales transactions. Did the sale happen or was it authorized? So one, we can choose one sale, right? We choose one sale, saying, okay, we sold goods maybe to Avic International, we sold cement to Avic International. So now we can inspect the existence of the sales order note. So we get the sales order note. So obviously, when when a sale is made, there's supposed to be a sales order, right? Even before a sales order, there's supposed to be a quotation that's issued. A quotation is issued, then the sales order, then a sales invoice is issued, right? And then when goods are sold, the sales dispatch note is issued, right? So now we need to go in the business and we ask for all these documents. If these documents are present, then we can confirm saying, okay, the sale occurred, right? But sometimes this happens where all the documents can be in place, but a sale was made to a non-existent customer, right? So
Yes.
we can inspect, you know, we can inspect the sales invoice as well as a good received note for the name and contact details of the customer and confirm their existence by calling them. We can get the sales invoice as well as the good dispatch note, good dispatch note, good dispatch note. Then we call them. Okay, is this Avic International? Are we through to Avic International? They're like, yes, yes, this is Avic International. Did you buy goods from such and such a company? Then they'll confirm. Then we've tested saying, okay, these documents, they are correct and this transaction did what? It did occur. Then three, you can inquire for existence of segregation of duties. Does one person prepare sales, order notes, invoices, and receive the payment, right? So we ask, are there segregation of duties in relation to sales? If we discover that one person is one that prepares the sales order note, is the one that prepares the invoice, is the one that receives the payments, and the one that posts the amount in the bank, then there's a chance that, okay, they can be fraud because this person can create a fake invoice. You know, they can receive a payment and not take it to the bank.
Yes.
They use it for their own
Yeah.
personal errands. Then after some time, that's when they deposit the money. So we
Yeah.
need to make sure, are there segregation of duties? Then four, we inquire for authorization of inventory before it leaves the company. When inventory leaves the company after a sale is made, is there authorization by a superior? If there's no authorization by a superior, then we can say, okay, obviously there can be fraud here because anybody can just say, oh, I've made the sale. But meanwhile, there's no sale. They just take the inventory to their place, to their house. And that's going to affect the financial statements. The inventory figure won't be accurate in the financial statements. Then accuracy, correct quarter amount. Were these sales recorded at the correct quarter amount? What tests are we going to undertake? So we can inspect the sales and receivables ledger and compare the amounts recorded, right? So we're trying to evaluate the accuracy, all right? So we inspect the sales, we inspect the receivables ledger, we inspect saying, okay, according to double entry, if a sale is for 1,000, it means even the receivables account needs to have a debit of 1,000. So now, if we check the sales for an invoice which is relating to a sale that was made to Avic International, but when we check the complementing entry, then there's a difference in the amount. The sale is 1,000, then in the receivables there's 1,000, there's maybe 800. Then there's a misstatement there. Then there's inaccuracy, right? So now, as the auditors, we need to test, we need to check. We inspect the books, we inspect the sales ledger, we also inspect the receivables ledger so that we compare and see if there's a level of accuracy. So sometimes you can also get the invoice, the invoice that was sent to Avic International. We get that particular invoice, we check, okay, the sale that was made is 1,000. Then now we go to the books, we go to the entries, and we confirm on this particular day, did you sell this particular amount to Avic International? And they say yes. Show us where this transaction is. They say, okay, this transaction was made on this day. Then we confirm the balances. If the invoice says 1,000, then the entry says 800. Then you see, then we've discovered an error. Then that's a misstatement. It means the amount of sales in the statement of profit or loss is misstated. All right.
Yes.
Then we can also call the customer as I already alluded to. We can also call the customer and just confirm the amount that was purchased. So if the amount, maybe I remember one day you talked about a customer who was owing, I don't know, about 900,000, is it?
Yeah.
Yes, those amounts, 900,000, that's an invoice that was sent to a customer. We can call them saying, okay, did you on this day buy products with 900,000? Since that is material, that amount is quite huge, it's material. They'll be able to
Yeah.
confirm, saying, okay, yes, on this particular day, actually, we didn't buy goods worth 900,000. We actually bought goods worth 1 million. But here in the books of our clients, it says 900,000. But you're saying you bought 1 million worth of goods. Then there's a what? There's a misstatement. Then completeness, where all transactions recorded. So now, again, it's just the principle of double entry. When a sale is made, it's supposed to be a double entry. Now,
Yes.
was the relevant double entry um, was the relevant double entry recorded if um, the client was working as an agent? What entry was made? Was it the whole amount of, say, 50,000, or maybe it's the commission that was included in the sales figure, right? Then classification, where all the transactions are deposited or posted in the relevant account. So we inspect the accounts. We check if the sales and receivables were posted in the correct account. We just check the receivables ledger, the sales ledger. Then we check, okay, these were posted in the right accounts. Then if a company was acting as an agent, we inspect the transactions if they were recorded according to the IFRS uh, 15 provisions.
That.
Yes.
Yeah.
So if it was acting as an agent, we don't record the whole amount of sales that were sold. What do? We record the commission as revenue, right? Was that done? Has the company done that? Then we inspect the book, saying, okay, you acted as an agent here. How did you record it? Then they show us. Then we'll be able to obtain sufficient appropriate evidence. Then for purchases, I don't know. Any questions so far?
No questions.
Contributions?
Consider just the experience. So mostly
Mm-hmm.
just the experience.
Yes.
Yeah. So in terms of accuracy and also testing for controls, we are the manager, though is I won't say the name since this is the court date. We had one of the managers who was fired. Since he was a manager, so he could go to the till uh, invoice himself.
Mm-hmm.
He gets that invoice, he gets the goods,
Mm-hmm.
he delivers the customer, he collects cash, and he takes the cash to the bank.
Mm-hmm.
So at times he was not taking the cash at the bank, and no
Yeah.
one could question him because he was a manager.
Oh,
Manager
yeah.
have got that unity to say, the manager was thinking our phones.
Mm-hmm.
Yeah, so now, you know how things are. At just some point, things will come up. So
Yeah.
there was some issues where the invoices which we are reflecting in our aging analysis, the receivables,
Mm.
was different from the customer's payable account. So we
Okay.
had to compare and match those. The customer said that all these invoices that you have, I've already paid for them.
Okay.
So balance I'm remaining with is just maybe 50,000. But in
Okay.
our receipt, it's still showing that that customer has not yet paid. But
Okay.
meanwhile, the customer paid and gave the money to the sales manager, and the sales manager ate the money.
Oh. Oh, so even when I was explaining, you're able to relate, eh?
Yes, yes, yes. So I was relating to say, this is what has happened at my workplace.
Oh, yeah, yeah, yeah. Oh yeah,
Yeah. So it was searched for fraud. The same thing that you were saying was searched for fraud.
yeah. Oh yeah.
To say, so segregation of duty is very important. So even if you as an accountant don't do everything. Even
Yeah,
me,
yeah.
I've been separate. At least these others post, this receives. It also protect yourself as an accountant
Mhm.
than doing everything because the temptation is there. You're the one
Yeah,
who
yeah, yeah.
carries the money bank. We are human. Ungagwire poka.
Money is easy to steal. Yeah,
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 so it's better to say there is segregation of duties.
yeah. All right. Thank you very
Yeah.
much. Okay,
Okay.
so now let's look at the purchases. So the controls relating to purchases, the test for controls relating to purchases. So again, we're going to start by occurrence. Did the purchase occur? So an example, we can choose one purchase. We check for the existence of the purchase order note, supply invoice, and goods received note. So this is just the opposite of the sales, all right? So we just check, did it purchase occur? We check the supply invoice. We also check the goods received note. We also check as well as the purchase order. So if these documents are in place, then we can also confirm saying, okay, these goods were actually purchased. If these are not in place, then we can have those doubts saying, okay, maybe this was a fake purchase. Then we can compare the name and contact details on the three documents and contact the supplier. So we can, we just confirm. So if since because the supplier is one person. Obviously, on the supplier invoice, the goods received note as well as the purchase order, it's supposed to have the same name as the receiver and the same address. So we need to compare the names. And after we compare the names, we can contact the supplier. If the amount that they supplied to us is material, it's a large amount, we can call them and confirm saying, okay, on this day, did you supply such and such products to our client's company? Then the supplier will accept or refuse, and they're going to confirm the existence of that particular purchase. Then three, we can inquire for authorization of purchase. So obviously, in a normal company, when an employee is making a purchase, there's supposed to be authorization. A superior needs to authorize such that when that sale or rather that purchase is made, that person who authorizes can bear the responsibility for that purchase. So if it's a fake purchase, then there's a signature of authorization. Then we can say, look, Mr. Manager, Mr. Director, you authorized this sale, but this purchase rather, you authorize this purchase, but it's non-existent, right? Then we can inspect the inventory in the books. All right, you said you purchased inventory with 1 million. Okay, just show us if you've sold some, but show us some of the inventory that you have. So we go and inspect the inventory that the client has, then we can confirm the occurrence of that particular purchase. Then accuracy, was it recorded at the right kwacha amount, the correct kwacha amount? So we inspect the purchases and payables ledger and compare the amounts recorded. So it's just the opposite of the sales test for control. So we go in the purchases ledger, in the payables ledger, we compare the amounts there. Ideally or effectively, according to the rule of double entry, these amounts are supposed to be equal. They're supposed to be the same, but maybe due to human error, they may be different. Then we can say, saying, oh, there's a misstatement here in retail management. Okay, correct this particular transaction. Then we can compare the purchases ledger entry with the relevant supply invoice. When we're given a supply invoice, right? It means
Yeah.
we have made a purchase and we owe that particular supplier and we record the transaction as appropriate. So we just get that invoice, we go to the books, we inspect the book saying, this is the invoice that we have. Where is this transaction? You check that particular transaction, you confirm the amount that was purchased. All right, just to make sure everything is correct. Then completeness, where all transactions recorded. Again, this is the typical example is double entry. Was the double entry properly recorded? We inspect and compare the purchases ledger as well as the personal supplier account. Then classification, we inspect the accounts to check if the purchases and payables were posted in the correct accounts. So if there's a purchase that was made, one entry is in the purchases ledger, then the other entry you discover it's maybe in the expenses for electricity bills, then there's a misstatement. Then we have to tell management to make sure they do the right thing. But for us, then we've gathered evidence saying there's an error, there's a possible misstatement that the purchases as well as the receivables figure in the financial statement is going to be misstated due to these errors that we've discovered. Yeah, then also there's cutoff. So cutoff wasn't really included here because it's not really a problem as much, but cutoff also have cutoff where you're comparing or you're trying to analyze and assess if a transaction was recorded in the correct period. Just trying to figure out if it was recorded in the correct period, then we can also check the invoice. We're given a supply invoice, we check the dates there, then we also check the date that was recorded in the particular um, ledger account. Then we just compare the dates and we can see whether the transaction was recorded in the correct period or not. If it wasn't recorded in the correct period, then we know saying, okay, here there's a misstatement, then the financial statements are going to be affected. Any questions so far?
No questions.
Or contribution?
Contribution are just the same.
Uh-huh.
So yeah, so like today I received something from purchasing department.
Mm-hmm.
Invoices, I mean receipts of goods in the system,
Mm-hmm.
but there are no attachments.
Mm-hmm.
There are no supporting documents like invoices
Mm-hmm.
to show that what they have done. Actually, the suppliers gave us, we gave the supplier a purchase order. Then the supplier gave us a goods received note as well as we received the goods. But
Mm-hmm.
those documents were not there. So
Oh,
that's the, yeah, I was quoting about. So that happened today. So as you were teaching, so I was just relating to say, that's the
oh yeah, yeah. Yeah. Hello? Hello?
hello.
Hello?
Hello? I'm getting you.
Yeah, so I think you had a problem with network.
Okay, 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 okay.
Yeah. So we can carry on, huh?
Yes.
Okay. So now we're going to look at cash. So cash receipts and payments. So these are just included in one explanation because for the most part for um, cash, what the examiner likes is they give you a scenario. Then you're supposed to detect the deficiencies in the internal controls. So now the issue is you need to understand the the transactions which may result in errors or misstatements in relation to cash. So cash, we don't really focus on the assertions, but you need to understand just how cash is stolen or how it can be misplaced. But the issue is you just have to have a general idea of how cash can be misappropriated, right? So now
Yes.
the controls that the auditor can carry out when it comes to cash receipts and payments is one, we need to check for segregation of duties. We need to verify that different individuals handle cash receipts, disbursements, as well as reconciliations, right? So we have to make sure we check are there segregation? Is it the same person who's receiving the cash, who's making the payments, as well as reconciling those particular transactions, or is there segregation of duties? So if it's one person who does the job, all the three particular roles, then we can know saying, okay, here they can be fraud, as you already explained about the director who was involved in that particular situation. Then we can also assess whether there's proper segregation of duties between authorizing, recording, and custody function. So the person that authorizes is not the same person that's supposed to record as well as have custody of the money, right? So if the same person who authorizes is the same individual who receives the money, then there's an issue there. Then the chances that fraud can be committed because that individual is just too powerful. They have access to just so much money. Then there can be also authorization as well as approval. We can review the policies and procedures for authorizing cash transactions. So when there's a cash transaction, who authorizes? Who bears the responsibility if cash were to go missing? Right? If there's nobody who authorizes, cash just goes out anyhow, anybody can get money, anybody can withdraw money from the bank, then we can say there's a problem with the controls. So the control test that we can use is we need to review the policies as well as the procedures for authorizing cash transactions. Then we can also check if there's appropriate approval for cash disbursement. So if you're making a payment, you bought goods inventory from a supplier. When those goods are purchased, now when it comes to paying, when we're paying the supplier, is there some sort of authorization? In most cases, I think maybe it's the finance director who authorizes the payment of the supplier, right? Is there authorization? Is there a signatory? When the that authorization is made, you know, for maybe invoices as well as expenses. So there's supposed to be some sort of authorization. If there's no authorization, then there might be chances of fraud as well as misstatement of the particular monies that are involved. Then physical safeguarding. So we need to inspect physical security measures for cash, right? If money, maybe we're auditing a retail store. So sometimes retail stores, when they make their sales, since they close in the night, maybe 18 hours, and banks are closed, right? They can't take that money to the bank. They need to put it somewhere where they can save it, where they can secure it. So do they have a safe where they keep that money? Or maybe it's the individual, or maybe it's the manager of that store who gets the money and goes with it home. Those type of things. So we need to inspect for physical security measures for cash. Then if there are no security measures, then we can see, oh, maybe cash can be stolen. We also need to confirm that cash is properly secured during transit. So when cash is moving from the premises to the bank, how secure is it? Right? Because sometimes um I think when I'm going to the library, I see these G4 vehicles, these G4 armored vehicles. They're coming to ABSA. They're
Yeah.
coming to ABSA, they're bringing money, right? So now, we as auditors, if we're auditing a retail store, we can go to the retail store, then we just sit and observe how cash is moved, how secure is it, right? Then that's a test for control that we're carrying out. Observation or observing the security that's surrounding the transit of money from the premises of the client to the bank. Then reconciliation and documentation. So we can perform bank reconciliation, right? To confirm that the movement of cash to and fro in and out of the bank. If it's accurate, we can reperform bank reconciliation. So if we perform bank reconciliation and we discover that the person that carried out the bank reconciliation did not do it appropriately or accordingly, then we can say here there's a misstatement, right? And we can also observe the bank statement, right? We check the bank statement, we check how the
Yes.
transactions are flowing, because sometimes there are these unusual transactions, you know, cash is moving in and out the bank in a suspicious way to the same account. which is a suspicious account, then you can say, oh, wait, who's this account? Is this a supplier or not? Then you check the supplier, the supplier list, um, the supplier register. You discover that that account is not relating to any supplier whatsoever. Then you can say, okay, maybe here it can be some fraud which is happening. Any questions?
No questions.
All right, so we're going to look at payroll tests. So payroll tests, I think they're not really examined as much, but in our paper, audit in September 2023, we came, I think there was a question that came, just explain two payroll tests. All right, so for the sake of that, we can also look at the payroll tests. So the payroll tests, some of the payroll tests include we inspect for signatures for employees who receive money to ensure that the person entitled to the money receives it. Yeah, so here what we're trying to do, the control objectives, we need to make sure that the individual who's receiving the money is he who is entitled to that particular money. Right? So we have to check for signatures. I'm sure when you receive some money as your salary, you sign somewhere. I don't know if I don't know how accurate that is. Do you sign somewhere when you receive your your dues?
Your son? No,
You don't?
we don't, because it's sent through the bank. So the bank acts as what can I say? Uh, the concession can be done through the bank.
Okay.
So I have a bank account in my name,
Uh-huh.
and the payment will be sent to that account. So
Directly
by
to the account.
it to the account, it's a sign that I've received the money.
Yeah.
Yeah.
Yeah. But for those small companies, I think I remember.
Yes, I know the Chinese companies mostly.
Yeah, those small companies where they don't have that system of transferring directly money to the bank, they pay the money in cash. So we have to make sure we check if there's a signature to confirm that this particular individual who received the money is one who's entitled to that particular money. Then we can also inquire if there are policies and procedures to ensure that employees collect their money themselves, you know. So we have to make sure we check if the policies and procedures were put in place to ensure that the person that receives the money is the one that's entitled to that particular money. We don't have to transfer the money to your wife's account, for example. We have to make sure the person that receives the money is the individual who worked for the money, and that is why it is sent to your account. So that we make sure that that amount is sent to the one who is entitled to that money. Then we can also inquire for authorization for amounts paid as salaries. So to make sure that the amounts they are paid to individuals who are entitled, you know, so there can be authorization. You know, the finance manager or maybe whoever can authorize before any salary is paid to any individual. We have to make sure that there's authorization somewhere. You know, if money is just paid without authorization, then it means salaries can be paid to ghost employees. You know, someone who doesn't work for the company, but they've registered the name. Since there's no authorization, they can pay that individual and claim that particular person worked for the company, but instead that individual is a ghost employee. So now we need to check that there's authorization somewhere. Then also need to inquire from management if there's segregation of duties between one who records the hours worked, which is a human resource, one who posts the payment, which is maybe the assistant accountant, and the one who makes the payment, which is maybe the accountant. So there's supposed to be segregation of duty. Not one person is the one that records the hours, one person is the one that posts the payment, then one person is the one that makes the payment. It's easy for the person to record a ghost employee. You record a ghost employee as if that person works for the company, but they don't. Then they post the salary payment to that particular individual who doesn't even exist. Then they also make the payment of salary to that particular individual who also doesn't exist. It's like what we heard about the Danny, was it was this Dandy Crazy? It is a ghost
Yes.
workers, you know.
Because that's political.
Yeah, you see. So now that's the,
But ghost workers, they exist,
uh-huh.
especially in government institutions,
Yes.
because the employees are more than 1,000. So
Mm-hmm.
there is a likelihood to have ghost workers there.
Mm-hmm. So
Yeah.
now, yeah, we need to check. We need to. So that's what we auditors check. That's what the job of the auditor general is. They're supposed to go and check for these things. We compare. We look at the employee sheet. How many employees are in any particular business? Right. These are the employees. Then these are their accounts. Then we confirm if these individuals are real or not by carrying out a secularization. You make sure you check and compare so that you ensure that these individuals are the ones who are receiving money, are the ones who are entitled to the particular amount. Any questions or contributions?
The contribution is as you are doing this test controls for payroll.
Mhm.
There is where you've stated that you do a secularization to all employee, maybe just to confirm if they work.
Mhm.
You can also do head count. Can that work?
Head count. What's head count?
Counting the employee
Oh,
physically.
oh, okay. Oh, yeah, yeah. It can also work, but in a situation
Maybe it
where there are a
can
lot,
take more time. Yeah.
yeah, if there are a lot, it can take. But maybe if there are a few, say 10, yeah, it can also work. It's just,
Okay.
yeah. So you've got the employee register. Maybe you say you've got 10 employees, then you just bring them. Okay, bring them out. These are the employees, then you count them. Okay, so that's also confirmation of the information. Yeah, that can also work. That's a valid point as well.
Okay, we can proceed.
All right. So now, so in some instances, I remember the conversation that we had yesterday when you talked about the Nigerian, when you're
Yeah.
working for the telecom, who came to audit
Yes. Yeah.
IT, the,
Yes.
because the auditor was focusing more on the books and not the electronic side of the audit, right?
Yes.
So now, there's what we call using the work of an expert, right? So the definition of an expert is a person or firm with skill, knowledge, and experience in a field other than accounting and auditing. That's an expert, right? Then an auditor's
Yeah.
expert is one who has expertise in a field other than auditing and accounting, whose work in that field is used by the auditor to obtain sufficient appropriate evidence, for example, a lawyer, right? So when an
Yeah.
individual is engaged by the auditor to help them gather audit evidence, that particular individual is what? Is the auditor's expert. So the way that that man, that Nigerian who studied ACCA, came to audit the IT, the IT section of the company, that was an auditor's expert. So that information was used by the auditors to express an opinion. Then now, management's expert is one who has expertise in a field other than auditing and accounting, whose work in that field is used by management in the preparation of financial statements, right? So, for example, a property value. So, when you are revaluing a property, management doesn't really know how to value their property. They need to engage someone who's an experienced valuer, right? So that individual who's an experienced valuer is helping management revalue the particular property or asset. Then that's a management's expert because it's an individual who has experience in a field other than accounting and auditing, but they're helping with the preparation of financial statements because that amount which is revalued is recorded in the particular in the financial statement, which is a statement of financial position. Then the
Yeah.
auditor must, so for the auditor to use the work of an expert, so the auditor must evaluate whether the expert has the competence, capability, and the objectivity to do so. So if they have the capability as well as objectivity and competence to carry out the expert's job, then the auditor can engage them. Then the expert must be aware of their scope of work. So the auditor and the expert, they need to negotiate so that they know the expert knows the nature, the scope, as well as the objective of their work, right? Then manager must assess the work of the expert. So when the expert carries out the work, the auditor needs to review and assess this particular work that has been carried out by the expert. Then sometimes the auditor can also use the work of the internal audit function. So each company, if the company is big enough, it has an internal audit function rather. So right, then the
Yeah.
auditor, to reduce the scope of their work as well as the time and the effort, they can use the work of the internal audit function. But the objective is one: the auditor must determine whether the use of the internal audit's work or direct assistance will be required. So they can choose whether to use the work of the internal audit function, or they can use the direct assistance of the personnel in the internal audit function. So if the work of the internal audit function will be used, the auditor must determine whether it's appropriate to use the work of the internal audit, right? Then two, if direct assistance of the internal audit will be used, manage, or rather the auditor must direct, supervise, and review their work, right? So these are the important points that you need to know. So the auditor can choose, or the auditor needs to determine first, are we going to use the work of the internal audit function, or are we going to use the direct assistance of that function? Then if we're going to use the work of the internal audit function, we need to determine whether it's appropriate to use that particular internal audit function. Then two, if we're going to use direct assistance, where the personnel in the internal audit function comes and helps us with our audit, we need to direct, supervise, as well as review their work. So now, how does the auditor assess the work of the internal audit function? So one, the auditor needs to assess the objectivity of the function. The auditor needs to also assess the competence of the function. Then three, the auditor needs to assess if whether the internal audit function uses a systematic as well as a disciplined approach, right? So now, how do we test the objectivity? The function of the internal audit needs to have a status. So we need to look at the function's status in the organization. If the internal audit function is held in high regard, the individuals in the company, they respect the internal audit function, then it means they are objective to some extent. Then other responsibilities, you also need to look at the other responsibilities. If the internal audit function has other responsibilities apart from their internal audit function, which is to make sure the internal controls of the company are functioning as appropriate, then there's a chance that they might not be objective. Then membership in a relevant professional body. So professional bodies, they prompt, or maybe they encourage their members to be objective when they're carrying out their duties. So if the internal auditors in that internal audit function, therefore part of the professional body, maybe the Institute of Internal Auditors, then there might be a chance that the internal audit function can be objective, and thus the external auditor can rely on the information of the internal audit function. Then the last point is, does those or do those charged with governance take charge of recruitment process? If yes, then they can be objective. So the individuals who are supposed to employ the internal audit function is those charged with governance, which is the board of directors, or maybe through the audit committee. They need to employ the internal audit function. So if those charged with governance, the board of directors, they carry out that duty effectively, it means that internal audit function can be objective. Then point two, competence. How do we assess the competence of the internal audit function? So one, the level of resources relative to the nature and size of the function. So if the internal audit function is paid accordingly, it means we're going to employ people with the right skills, knowledge, and experience. But if the resource allocated to the internal audit function is not enough, then we need to employ people who are not as experienced. So sometimes we can just employ students who are not very experienced to cushion the cost of labor, right? So you just go to the University of Zambia, you go to CBU, you just pick out these young people who don't have any responsibilities, you pay them matupin, then they come and work as internal auditors because the level of resources are very minimal or they are little given the nature and size of the function. Then it means that particular internal audit function may not be as competent. Then are there established processes and policies for recruitment, training, and assigning internal auditors? So if there's a solid system for employing, for recruiting and training these internal auditors, then we can say we can rely on the work of these particular internal audit function. Then education and training of internal auditors. Are these internal auditors well educated? Do they have the relevant training, right? Do they have the relevant experience for them to carry out their job accordingly? If yes, then we can rely on their work. Then are they members of a professional body? So if they're members of the professional body, there are chances that they can be receiving CPD, continuous professional development. So then they're going to have professional competence as well as due care. Then the last point is systematic and disciplined approach. So now, does the internal audit function document the internal audit procedures? So for example, does it document the risk assessments, the work programs, the documentation, as well as reporting? So the internal audit function, they review the internal controls. Then they carry out the risk assessment. And then when they carry out those risk assessment, they need to create responses. So before they create the responses to those risks, they need to document everything that they observe, which is not working accordingly. So now, does the internal audit function do that? So if the internal audit function does that, it records, it carries out a systematic and disciplined approach, then we can say we can rely on their function in order for the external auditor to reduce the scope of their work by relying on the internal audit function. Any questions so far?
No questions.
Okay. So now, so sometimes,
Mr.
yes,
Hello.
yes.
I wanted to find out. So the internal auditors, their audit report, where do they submit? Is it to directors or it's to shareholders?
So the
Or
internal,
they are just there for control purposes?
yes. So the internal audit function, the main job is to review the internal controls so that we can improve the operations of the company. So their report, when they prepare that report, it's used internally for management.
Okay.
Yes.
Okay.
Yeah. So this is one of the differences between an internal audit as well as an external audit. External audit is used by external users, but internal audit reports they are used by management to make decisions and improve the controls of the particular company.
Okay.
Yeah. So now, so we need to determine the nature and extent of work when we are using the direct assistance of the internal audit function. So instead of just using their work, we get some of the workers, the internal auditors, they help us with our external audit. So one, the internal audit function must not perform the following. One, work which involves making judgments. So any work which involves making judgments, the internal auditors must not undertake this particular job. So work in areas where risk of material misstatement is high. So if risk of material misstatement is high in a particular area, an internal auditor whom we're using for direct assistance must not uh, audit that particular area. And if that area also involves judgment in applying procedures which is high than the limited, then that's also an area where that particular internal audit function is not supposed to work in. So the work that also it relates to the work which the internal audit function performs. So sometimes the internal audit function may create controls. So any work that the internal audit function performed, when we're using their direct assistance, we're not supposed to give them the same work because that can be a self-review threat. You know, you're reviewing something that you prepared, and that's going to be a problem, and it's going to affect the independence of the internal auditors. With that said, our lesson has come to an end.
Okay.
Any questions?
No questions, Mr. Patrick.
Then any or contributions? Let me just record in the recording.